that the drop? Is that the drop, Gabby?
Goose, my love.
But the music's going to go down. Hello and welcome to yet another fantastic live Investor Lab. My name is Goose.
My name is Gabby.
And
I'm working on the fade, man.
Yeah, evidently, Gabby and I are still working out the timing. We're trying to get our like, you know, awesome show entry kind of rhythm down pat. We're still trying to work that out. So it's actually quite fun trying to work that out live. So thanks for bearing with us.
It's so fun.
It's so fun. Gabby's like, I'm like, when do I start talking? She's like, do it at the drop. I'm like, what do you mean at the drop? Like, what? I'm like, can you give me a signal? And she's like, you know, the drop, just do it at the drop. I'm like, well, the music's got to fade out a little bit before I start talking. Anyway, so here we are.
Nah, go for it. At the drop, Goose. Come on.
Drop it like it's hot. All right, we are here. We are live. If you are here with us live, let us know in the chat. Make yourself known. Say hello.
Hello.
Nice to see you, Arvin. Nice to see you, Kim. Nice to see you, James. Nice to see you, Matthew. Good to see you here. If you're here and you're not in the chat and you're not letting us know, what's up with you? Because we're here talking to you.
What's up with
How weird would it be if we were all sitting in a room and you were just sitting there silent, not saying anything? We're hanging out talking to you. So stop being a weirdo. Say hello in the chat.
Weird, guys.
Peter said we nailed the intro. I also think we nailed the intro. Bit more confetti next time, Peter. and we will have it.
Ooh. I'll get distracted. Anyway, already distracted.
Don't get distracted with confetti. All right. So if you're here, say hi. Let us know that you're here. And also remember that the reason we do this live is so that we can interact with you and so we can get your questions. We can talk. We can have a conversation because we believe that it is very important for everyone to progress their financial intelligence. And we can better do that if we learn from each other and interact with each other and ask questions, because otherwise it's just us here saying a bunch of stuff at you. And whilst that is an acceptable medium of exchange, it's not the optimal medium of exchange. Speaking of medium of exchange, Gabby, what have we got in store?
Oh, I love it. I love it. You are proud of that too. I can feel it.
Yeah, I know. I nailed it. What a segue. What are we talking about today, Gabby?
Well, it's funny, right? Because every week so far, so this is the 9th week that we've been doing this live, Goose. And we've always wanted to do like a hot takes of what's happening in the news because there's so much happening. But the topics that we've had so far have been so meaty that we've just gone, you know what, let's just stick to the topic. There's not actually enough time. Even like we started these doing them at 60 minutes, and we expanded them to do 90 minutes because there's so much in here. We love connecting with the community, being able to actually answer your questions as you need them every week. And so, but then this week we're like, there's actually too much to talk about. So we just wanted to cover some really interesting stories. We're covering 3 major stories that are happening at the moment that you may have heard about, you may not have heard about, but it's really like this soup of what's happening in the financial world and how they're all kind of like molding together to help us get a sense of maybe what's going to happen in the economy moving forward this year.
Yes, I'm going to expand on that a little bit. So I'm a big advocate of us incorporating current events as to what's happening in the world. Because what I think is that we have already established over the last few episodes, and we'll continue to establish that there is an effective framework of how you can navigate through the world financially and achieve financial success, fundamentally based around the ideas of, you know, scarce desirable assets like real estate and Bitcoin, disruptive assets like technology, and how you can navigate, how you can leverage those fundamentally to transform your financial future and to get to a better state. That is laid against a backdrop of a failing financial system, a broken monetary system, and an inflating world, right? So there's all these kind of like ideas. Now, we could bang on about those ideas ad infinitum, but actually what's better is if we can then put those over current events like a jacket to go, hey, look, here is this thing that's happening in the world. Here's how it relates to these ideas. Here's why you need to understand these things, because that's going to keep us in the present moment, understanding what is happening. So what's the first topic we're going to be talking about? We're going to be talking about gold, right?
Yeah. So the three topics for today, the major kind of stories that we think are really interesting: gold scandal that is happening right now, liquidity is up, and markets are down. They're kind of the headlines of where we're going to dig into. So if you have any questions as well, if you've been to these at all in the last couple of weeks, you know that we love interacting with the chat. So if you have any questions or any ideas come up as we're talking it through, leave it in the chat. We'll pull it up and be able to discuss it with you that way.
Yes. Good.
Yes. Good.
Should we just get into it?
Yeah. Gold.
Yep.
Let's go.
Let's go. Gold. Okay. So let us know in the chat if you are aware of the fact that there is a bit of a gold scandal going on at the moment. So gold has been the best, or has been viewed as the best, most sound version of money for the last 5,000 years. And just as a reminder, what is money? Money is a medium, money is a mechanism to be able to transport your economic energy through time and space. That is what money is. Your currency, your Australian dollars or your US dollars or your Thai baht, they are political currencies. Currencies are simply a unit of account and a medium of exchange. They typically aren't a store of value. And money must have three characteristics: store of value, medium of exchange, unit of account. Jason's right. It is, in fact, a gold rush at the moment. We're going to be talking about that. Now, for about 5,000 years, gold has been the best form of money, or it has been viewed as the best form of money. And why has it been viewed as the best form of money? It's been viewed as the best form of money because it has been reliably scarce. That has been one of the characteristics of it. Scarcity is actually really, really important. And this is, in fact, why political currencies don't serve as an effective form of money, because they can be printed into existence. So you can just print more and more and more of them, right? And so they're not an effective store of value. Therefore, you can't transport your economic energy through time and space, which is the critical function of money. That is what money is. It's a mechanism to transport your economic energy through time and space. And the better the quality, the better the monetary qualities, the better it can transport your economic energy. So gold has been reliably scarce for centuries. Now, what do I mean by reliably scarce? Do I mean finite? No, I don't mean finite. What I mean is that over the last however many, for thousands of years, the stock to flow ratio has been fairly consistent, and the supply of new gold coming into the market every year has been reliably at between 1.5% and 2%, right? So roughly 1.75% a year on average for as long as forever. Now, why has that stayed fairly constant? It's because at first gold was easy to find and easy to get because, it was just rocks kicking around. So, people could get it, and then it got harder to get. And so, you had to deploy better technologies to be able to get it and stuff. So as it's gotten harder to get, the technology's improved, and that's just happened to kind of move at roughly the same rate. And so we end up with roughly a very consistent new inflation rate of gold coming into the market. So it's on average, it's increased by about 1.75% a year, basically forever. So it's been reliably scarce. There hasn't been like some way to suddenly release heaps more of it onto the market or anything like that. Although they have found comets and stuff recently that are like got just stupid amounts of gold in them and stuff like that. So there is more and more and more and more gold being found. Now, all that being said, it has been, this is why we used to have gold-backed currencies. So it was because there was a foundational understanding that gold in and of itself was good money, sound money. In fact, if the term sound money, Gabby, could we maybe stop bobbling the screens around? It's distracting me. Distracting me a little bit.
Hang on, buckle up. Okay,
cool. So actually, the term sound money is actually really interesting because it comes from the idea that when you had a gold coin, you could actually, it would make a sound. It would like ting, and it would have a ring to it. So that's where the term sound money came from. And hard money comes from the idea that you can't make more of it. It's actually physically hard to create and get, and all of this kind of stuff. So this is where these terms come from. So gold used to be money. We had gold coins, and then silver coins were worth less than the gold coins because the ability to provide more silver into the market was easier than it was to provide more gold into the market. And so it had it was easier money. It was less hard. You were able to inflate the supply easier, so therefore it held value less well. It was more readily found, more readily available, cheaper to get, so it was not as valuable, not as scarce. And then copper again was one step back from that. And so over time, so we had gold coins and all that kind of stuff. The problem with gold is that it's not super portable. I mean, you can make it into gold coins, but it's in en masse, it's not super portable. It's not easily divisible, right? To divide it up, you actually need to have like machines and all this. It's not easily divisible. You can't take a gold coin and just chop it in half. But also the verifiability of it is an issue. How do you know that it's pure gold? This has actually been one of the biggest issues, the verifiability of it and the portability of it. And so what is happening right now is that countries all around the world are trying to repatriate their gold and trying to get their gold back from places like the Bank of England, which has been one of the biggest, one of the primary storage places of gold. And they're actually finding that there might not be enough gold there. And they're also finding that the gold might not actually even be gold. They have verifiability issues. So there's a lot to unpack here. But let me just kind of keep riffing on this for a second, because it's, and then we'll see where we get to. So the Bank of England has been the primary storage facility for the world's gold reserves. So most countries store their gold at the Bank of England. But there are roughly 10 times more claims on gold than there is actual gold. So most gold, because of its lack of portability, because it's so heavy and so hard to move around, people don't actually buy gold. Like, unless you actually physically have it in your person or in a private vault in Singapore or something like that, you don't actually have gold. You have a paper receipt for gold. So this is no different from fiat currency, because somewhere someone's going like, yeah, the gold's sitting in a vault over there. Let me just give you a little IOU slip for that. The problem with that is there's roughly 10 times as many IOU slips for gold than there is actual gold. Now, that's a fact. That's not theory. That's fact. Is it 10 times? So look, I've seen anywhere between 8 and 10 times, but whatever it is, it's big, right? So depends on how you measure it. It's very hard to check. But there's roughly 8 to 10 times as many claims on gold as there is physical gold, which is a pretty big problem, considering it's supposed to be the most sound money.
Yeah.
And all of a sudden, it's like not really there. So, I mean, we can go into that. One of the kind of points I want to make, though, is around this idea of portability, because this is actually where part of the big problem comes from. The portability issue means that everyone stores it in a central place, and then because it's so hard to move, what they do is they trade paper instead, and that's where the fiat breakdown comes from. What's interesting about that is that this, at the moment, the crisis that is happening is that everyone's trying to repatriate their gold. There's probably not enough gold. Like, if there's 8 to 10 times as many claims on gold as there is gold, well, there's going to be gold missing somewhere. And so what we're probably going to find is there's going to be a big empty something somewhere where there's not enough gold. Real estate, though, for example, is a great example of actually having something where it is easily verifiable and not very portable. Like, the lack of portability of real estate, the fact that it physically has to actually be somewhere, right, is actually one of the things that is going to allow that to continue to hold value. So we spoke a couple of episodes ago around the potential demonetization of gold in favor of things like Bitcoin. And I think that this is a great example of that, because if you look at kind of gold, it's not very portable. It's not very verifiable. It's got all these kind of problems with it. Then you look at real estate, it's easily verifiable because it's a physical, it's like it's there or it's not there. Just go on Google Street View. Like, it's pretty easy to verify that it's a thing. It's really not portable. In fact, it's so not portable that you can't even go and centralize it in a vault and start trading paper on it. It's like so unportable that that actually becomes a strength. But then you actually look at, but it's also it's not divisible at all. But then you look at Bitcoin, for example, and it's highly portable, which is actually, it's so portable that you can actually transport billions of dollars of it in a second, and it's highly divisible. So you've got these kind of like this bifurcation of how we think about the monetization of financial assets, and it looks like gold is starting to break down. So there's a lot more to unpack, but I'll stop there, catch your breath, and let you get a word in edgeways. What do you think, Gabby?
Let you take a breath. It's a super fascinating story, right? Because I think the trends over the last, I don't know, 3, 4, 5 years is this growing sense of, I guess, distrust in our financial systems. And as we've talked about in terms of the monetary system and currency debasement and everything, like, our purchasing power is getting weaker. That is factually correct, because of the powers that be printing more money, making the dollars that we hold effectively weaker. And I think that's part of why this is causing such a stir at the moment, because it's pointing towards, hey, this system and this fundamental kind of belief that everyone holds about the verifiability of gold, that's actually coming to question now, and it's fueling this ongoing sense of distrust in the systems, which I find really interesting.
Yeah, 100%. So let's talk about the verifiability, because we've spoken about the lack of portability, which has led to paper trading on gold. And there's like 8 to 10 times more paper claims on gold than there is actual gold. But the RBA, so this is this whole situation completely blows my mind. The RBA discovered that so the RBA stores its gold reserves in the Bank of England. We're going to come back to that because that's the most ridiculous thing I've ever heard of. But for some reason, Australia, which is a primary producer of gold, we produce it. It's one of our largest exports. We dig the gold out of the ground in Australia. Then we ship it to the UK to go put it in their vaults. Like 99% of our gold
no
is in.
Sense.
That doesn't make any sense. So like, why is that happening? We're going to come back. I've got some theories around that. Theories, not facts. But then the RBA discovered that that there was fake gold. That the gold, that some of the gold that was in the Bank of England's vaults was actually not real gold, and that it was it tungsten, nickel? I can't remember what it was, but it was basically gold plated some other metal, which basically it's like, okay, it's fake gold. Okay, what? So now, and so by the way, let me take a little step back. So in addition to that, so the RBA has sent its gold over to the Bank of England to store in its vaults. Every single gold bar has a serial number stamped on it, and there's a record of those serial numbers. So, the RBA has a big document somewhere that's got all of the serial numbers of all of our bars of gold that are stored in the vaults. Somewhere along the line between 2015 and 2020, I think it was, those serial numbers changed. Why? And so there was a bit of an inquiry into like, what happened to, the serial numbers have changed on our bars? What do you mean? Like, we've put them in storage. No one should be touching them. And there's two kind of lines of commentary on this. One is, well, yeah, we lent them out. The Bank of England said, yeah, well, we lent them out. We lent them out. It's like, yeah, but you didn't physically lend them out. You didn't actually take them out of the vaults and go lend them out to someone and then replace them with other bars of gold. No. We just lent them out on paper. So there was people that needed to borrow gold, and we just lent them out on paper. Okay, so let's just say that that's okay. So why is the serial number changed? Oh, because we replaced them with different bars of gold. What do you mean you replaced them with different bars of gold? Because our gold, which forms part of Australia's reserve asset, our balance sheet item, should be sitting in a vault somewhere, right?
Yeah.
What do you mean? Okay, so what you're saying is you didn't touch the gold, you lent it out on paper, and then someone returned it on paper, and somehow the serial numbers have changed. Yes, that's right. What? That doesn't make any sense. Then the other thing that was said was, well, we refined the gold. So what do you mean you refined the gold? And they did all of this without the RBA's permission, by the way. You refined the gold. What do you mean? Well, we melted it down and refined it and put it back into gold bars. That's why it's got different serial numbers. So hang on a second. You took our gold, which was verified in the first place. When we sent it over, we were quite satisfied that it was gold, and we sent it over as gold, and that was ours, and we put it in your bank. And then you've just refined it without our permission and put new serial numbers on it. So now we've got different serial numbers. Like, it's completely crazy. Australia's got something like 6.8 billion or something like that worth of gold. Is it? I'm not sure if you have that number kicking around, Gabby. It's something like that. It's like 6.8 billion.
80 tons, like 6 billion. Yeah.
Yeah, 80 tons of gold sitting in the Bank of England, and the Bank of England's playing funny buggers with the Australian reserve gold. So here's the solution. Here's the solution. We're going to send someone over there to go check 10% of it. What? Hang on a second.
Yeah.
We're going to send someone over to go check 10% of the gold. When we've just been told that they're lending out our gold, replacing it with different gold, which is unverified, refining our gold without permission. It's absolutely like, it's mind blowing. It is fraud on the highest level, in my opinion. What's your opinion on this?
I mean, it's hard not to talk about this stuff and just sound like you're ranting about conspiracies or things. I just think it's really interesting because, again, we have so much trust. There are so many systems in our lives that we trust in to do the right thing by everyone, by humans.
Yeah.
And this is one of those. Like the monetary system is one of those because that's how the system currently works, right? We don't individually have the capacity to manage our own economic systems. So we
Yeah.
rely on these centralized options that we have.
Yeah.
And it's just when you start to kind of think that those are being taken advantage of by whoever, like it may not even be malicious, but it's just like an ongoing spiral of, oh yeah, I've got some gold on paper, I'll lend that to this person and then they will have the gold and then they will lend that to this other country, and this spiral of lending ending up with that like 10 times more claim on gold than exists. It's just like that has to come to a head at some point.
Yeah, I absolutely agree with you, right? And so
Mm.
this is a practice. This is a process called rehypothecation. And rehypothecation is the foundational reason that the financial system and that money itself is broken. It is the core premise. So rehypothecation, let me read you a definition. I just quickly looked it up. Rehypothecation is a practice whereby banks and brokers use for their own purposes assets that have been posted as collateral by their clients. Right. So this happens all the time. This was actually what happened in 2008. This is what caused the global financial crisis. Rehypothecation is the act of taking somebody else's stuff that they've stored with you and then basically taking risk against it, right? So if I go and put $10,000 in a bank, right, I'm going, hey, my $10,000 is safe, and they're going, what's the probability that he's going to take the $10,000 out? Fuck it, we're just going to lend it out, right, and hope that I don't actually need it. Now, let me. I looked up something, and let me read to you the rationale. Right, this rationale. The Bank of England was chosen as the primary. So this is so. Why does the RBA store its gold at the Bank of England? Right. This is the fundamental question. The Bank of England was chosen as the primary storage location due to London being the world's largest trading center for gold. This arrangement allows the RBA to easily access the market, as most gold market participants prefer to take delivery in London. Hang on a second. Let's just unpack that. So gold is one of Australia's largest exports. We are a primary producer of gold. We don't need access to the markets. Now, the RBA does lend out, does officially, as part of its mandate, as part of its as a policy process, does lend out a portion of its gold, but it's a very small portion. So last year, the total earnings generated from the lending of gold was $1.3 million, off $6 whatever billion dollars, right? So yeah, $6.87 billion. So we're talking about very minor financialization. It is a reserve asset. It is not. It's not a trading asset. So we have produced it as a primary producer. Why is it that we then said, well, we better store it where everybody else wants to trade it? That doesn't make any sense because it's supposed to be stored as a primary reserve asset. So the only reason that would make sense is if there was some exogenous pressure from someone, the Bank of England, the UK government, the EU, the World Bank, something like that, to say, hey, you know what? We actually, if you're not going to use your gold, we're going to bloody use your gold, basically. So you got to put it here because, like, why can't we build a safe in Australia? Like, why can't we put it in it? So Peter here said, doesn't WA have a large gold vault? Yeah. So like, exactly. Why don't we store it there? So Peter, you would be very interested to know that of the 80 tons of gold that Australia has as reserve assets, 99.9% of the physical gold holdings are stored in the United Kingdom in the Bank of England, and only 4 gold bars are stored at RBA's Sydney holding point. What even is the point of holding 4 gold bars? So then the question is, why the hell have we taken something that we have primarily produced in Australia as a reserve asset, which is a form of sound money, and why have we shipped it to another country to put in their gold vault so that they can rehypothecate it and put our reserve at risk? And now there's 8 to 10 times. So if we want that back, how much are we going to get back? Is it even there? Now, this actually kind of points to, and we can come back to the BOE thing as well, but that's probably a good segue to also talk about what's happening with the US gold reserves, because this is also, so all of this is pointing to a really broken situation with gold, right? Which is so.
Because what I understand, just before, we'll go into the US stuff, but from what I understand, this discovery of the Australian gold reserves in the BOE being like having some counterfeits found, that actually happened in 2021, from what I understand. But it's kind of been resurfaced. I find it interesting that, I don't remember exactly what happened. There was a lot happening in 2021, right? But it wasn't as much of a topic then, considering that was when it was found, but it's been resurfaced now because of what is happening in the US and the things that are being questioned over there, if you want to dig into that.
Yeah, it's a really good point, right? Because actually, a lot of this is, so that there's a couple of parts to this. There's a couple of parts that this has all kind of started to come to the fore. One is that countries started asking for their gold back from the Bank of England, and they started getting told, no, we'll send it to you. Just give us a few weeks. Why can't we just have it like now? Logistics, Some countries are being told, no, we'll get it. No. And we absolutely have it in storage. It's just going to take us a couple of months. We've just got a bit of a backlog. So there's two parts to that. Why is there a backlog? Because there's effectively a gold, like a bank run happening on gold at the Bank of England. And countries are saying, I'm sorry, rehypothecators, we want our gold back because we don't trust you anymore. And so there's effectively a bank run happening in the Bank of England, right? And so that is caught. So that started to pick up some news. And then simultaneously, either, cause, effect, coincidence, whatever the case may be, there's been questions around the US's gold reserves as well. Now, part of that is driven by the fact that the US has broken through its debt ceiling. So, Gabby, I think we were talking about the fact that they've raised the debt ceiling to 40 trillion. That's actually not true. So right now, it's actually not true. Matthew Pitt, we're going to talk about that right now.
We'll come to that, Matt.
Yeah. So, the US is in a debt spiral at the moment. It's the repayments on its debt are they're over $1 trillion. There's $10 trillion of debt which is going to roll over next year, which would currently roll over on an interest rate of 4.57%, which would massively blow out the interest repayments. The debt to GDP ratios are at about 130%. I can't remember the exact statistic, but it's something like 90% of the time. 90% of all situations where a country has reached 130% debt to GDP, they've ended up collapsing. So they're in a very precarious situation. And so there's a lot of, the Fed's not really cutting rates. The economy kind of sucks in the US, all of this kind of stuff. We'll get to the markets piece in a minute. So there's lots of questions around like the US balance sheet. Where is the money? What can they financialize? All that kind of stuff. And gold is obviously a pretty big one. Now apparently there is about 8,000 tons of gold at Fort Knox. At least that is what they say. I think, Gabby, you wrote down there at about 147.3 million ounces. I think it works out to be about 8,000 tons of gold. Now, here's the thing.
So it should be around 428 billion worth of gold in Fort Knox.
Yeah, so this is the thing, right? So there's a bunch of parts to this. No one has audited the gold in Fort Knox since 1953. That was the last time there was an audit of the gold in Fort Knox. No one has checked how much gold is in Fort Knox. And they did a partial audit in 1974, but that was mostly just a PR stunt. They just like checked a few bits of it and said, look, kind of like how the RBA is going to go over and like check 10% of the. It's like, if you're going to audit it. Check it all. Because by the way, there's lots of precedent of this, because the Bank of China actually found, and there was a large public trust case in China where they found a whole bunch of gold bars they had in reserve were made out of tungsten. There was a company as well that had $80 billion of gold as a collateral on its balance sheet, which was a copper alloy wrapped in gold, right? So there's plenty of examples of gold being broken. So the last audit of Fort Knox was done in 1953. So no one actually knows how much gold is in there. They did a partial audit in 1974, which is basically a PR stunt. The US went off the gold standard in 1971. So they haven't even checked how much gold there has been in there since 1953, before they went off the gold standard. The gold that is in Fort Knox is currently valued at $42 an ounce, 42 US dollars an ounce, which was set in 1973. That was the price they set in 1973. And they haven't repriced the gold. They haven't marked it to market. Now, why? Why would you not mark it to market? Now, by the way, you will read stories that say, no, they check Fort Knox every year. They do what's called a seal check. So they walk around and they go, yeah. The doors are still locked. It's all good. The doors are locked. So they do a seal check once a year. That's all. They don't actually check the gold. They don't check the serial numbers. They don't check the volumes. They just check that the doors are locked, which is crazy. So no one's actually checked it. Now, and they haven't repriced the gold. They haven't marked it to market since 1973. Why not? Because at $42 an ounce, the current market price is around $2,950 US dollars per troy ounce, which would be about $428 billion in today's prices versus, I can't remember what it is, like six billion or something, or whatever it is, in 1973 prices. So it really begs the question, why hasn't it been audited? Is the gold even there, given that we've already established that there's roughly 8 to 10 times more claims on gold than there are gold? And why haven't they marked it to market? Now, one reason they might not have marked it to market is if it's not actually there. Mm-hmm. If as the price has gone up, they've then used that to trade, to do other stuff, to send other places, to rehypothecate, to move around, then in fact, maybe the reason they haven't marked it to market is because maybe the market value of the amount of gold, and this is just pure speculation, by the way, maybe the value that they've got on the balance sheet is representative of how much gold they've got in today's prices. Maybe they've just got rid of most of the gold. So maybe it's not really there. Now, this is a very important thing to understand, because the financial, like every government in the world has to be collateralized, and the collateralization of their balance sheet gives them the financial credibility to operate within a global financial ecosystem. If you undermine the credibility of any national balance sheet, you undermine their ability to participate on the world stage. So even though the US dollar is no longer gold backed, even though we don't use gold backed currencies anymore, we use fiat currencies, the quality and the soundness of a country's balance sheet is critical to understanding their creditworthiness and their fiscal management and their stability on a global stage. Imagine if all of a sudden, just imagine if everything disappeared off the US balance sheet and they effectively had no assets. Everyone would be like, what? You've got all this debt and no assets. This is crazy. No one would want to participate. So this whole kind of scenario is completely wild. Like it
is, yeah. I was thinking of just like a property analogy for ease, in case so people can follow. So in terms of like having this asset on the balance sheet, right? So we all, if we own a property, we have a personal balance sheet, and that property, the asset of the house, the value of the house sits on the balance sheet as an asset. But then we also have the debt. We have the mortgage to the bank or whoever. And so if you are fully leveraged, like if you have taken out 100% of the value of the house in terms of loans, nobody else is going to want to lend you any money, right? Because you're capped. You have no equity. Collateral. Yeah, you have no collateral left to keep lending. And in this situation, the argument is that maybe the asset value has gone down, but they haven't told anyone. The asset value has gone down because maybe they've moved it elsewhere. They haven't changed the actual value, or that the value is less or more than they say it is in the balance sheet. But it's like, it's this paper and words talking about the value of these assets, because they're trying to use it to leverage and kind of their game that they play in terms of debt and everything around the world.
Yeah, 100%. You're 100% correct, right? It's like, yeah, I mean, repricing the gold in Fort Knox, let's just say it was all there and they've repriced it at today's value. It's not going to change their debt. It's not going to lower their debt. They've still got $36.5 trillion worth of debt. It's not going to lower their debt, but it would improve their credit worthiness, right? Because they would have a stronger balance sheet. They would be more financially stable and more financially viable as a country. So what they would actually do probably, by the way, and this is an interesting thing that the current US, powers that be, Donald Trump and all those, they're actually trying to lower the bond rates now, but because what they recognize is they can't get the Fed, they can't tell the Fed to lower interest rates. They want lower interest rates. So how can you get lower interest rates without the Fed cutting rates? Well, you can lower the bond rates. So how do you lower the bond rates? You reduce the credit risk to bondholders, and so you make them more desirable. And so if they can firm up the balance sheet, then what that would do is that would feasibly. So if they can strengthen the balance sheet and increase growth and increase financial prosperity and turn the country into a growth engine, then they would be able to lower the 10-year Treasury bond yield, which is one of their key objectives. So Matthew asked, like, what would happen if Fort Knox was, let's just say it was empty. Let's say there was no gold there. Well, that would undermine the financial integrity of the US. And what that would do is that would shoot up. That would most likely shoot up bond yields or bond interest rates, because the credit viability of the US would be significantly undermined, and it'll be a much higher risk to hold US treasuries, which again would be very problematic from a liquidity perspective, because as the government needs to raise or lower liquidity, it would have less of a mechanism to do that, because less people would want to own US treasuries. So, and also then, given that the US is the global reserve currency and treasuries are the kind of like primary reserve asset, there's $300 trillion worth of bonds globally, not all US treasuries, but just bonds globally. And there's $18 trillion of gold, right? Bonds are a way bigger deal than gold is. But the crisis in gold right now has the ability to completely decouple the bond market, which would fracture the entire financial ecosystem. That's why this matters. That's why this matters. Whew. So it's a big one. So
it is,
it's and you know what it says to me, because a lot of people are like, okay, so if you like sound money, like, why don't you like gold? Well, I think gold is great if you own it, if you can physically store it, if you treat it as a bearer asset. Like if you actually physically have the gold, awesome. And I actually think that what's going to happen is we're going to see a bifurcation of paper gold versus physical gold. I think paper gold is likely to get cheaper, because like, why would you want to own a piece of paper if you don't even know if it's got a bit of gold attached to the back of it? Yeah. And so that's going to become, much riskier. And physical gold will, and this is, again, I don't know, but this is what I theorize may play out, is that paper gold will lose value, physical gold will increase in value. So net, you'll still end up with the same total global asset value in gold of about $18 trillion of gold, but all of the repricing will happen into physical gold that has been verified. But I think a lot of people are going to be left holding the bag. A lot of people that own paper gold are going to see that paper gold go to zero, and the physical gold holders are going to be the only ones who win. So,
and it has the ability to potentially crash the US dollar as well, right?
Well, I mean, it has the ability to destabilize the entire global financial ecosystem. And I certainly don't want to be one of those people on the internet going like, oh, doom and gloom, we're going to have a big financial crisis. Because I actually don't think so. Because I actually think that the governments have learned that the answer is just print more money. We can print our way out of it. So just to be very clear, I'm not sitting here saying, look out, we're about to have GFC V2. What I am saying though is that there seems to be a lot of bullshit being spoken about the actual collateralization of the financial sector, and that is going to undermine the credibility of the financial sector. What that is likely going to do is likely going to cause liquidity to increase, to soak up the risk premium that has to be applied to everything, which is going to increase money printing and stuff, which is probably a good segue to kind of move into the next piece, global liquidity.
Yeah, awesome.
By the way, let me just take one quick step back, because I mentioned it earlier, but I want to mention it again because it's actually really, really, really important. So when you think about the kind of like global pool of assets that you can own, whether it be stocks, bonds, gold, Bitcoin, all of this kind of stuff, the thing that holds true the most is that the best stores of value are scarce, desirable, verifiable assets, right? So that's why real estate is so bloody good. Now again, I've said it before and I'll say it again. The downsides of real estate are actually its strengths. Oh, it's not very liquid. Oh, the asset class is slow moving. Oh, all of this kind of stuff. That's why you can get leverage on it. That's why you can get such crazy returns on it. And no one's going to pick up your house and run away with it. Downside, if Victoria changes its laws and increases its land tax, you can't pick up your house and move it to Queensland because it's got better rates, right? So that's one of the downsides around the portability factor. But these things actually end up being strengths. Bitcoin again is scarce, desirable, verifiable. That is actually a great store of value. Stocks, I love disruptive technology stocks, but they can just print more equity. They can just say, hey, you know what? Actually, we're just gonna double the amount of shares on issue and halve the value of everyone's shares. They could do that overnight. The board could just decide to do it, and so and that is a version. It's not rehypothecation in its true sense, but that is a version of printable manipulation that can exist when you don't have when you don't effectively have a bearer asset or a bearer instrument. And so understanding that and really understanding that as how you think about store value, there's plenty of ways to make money. Making money is different to storing value. So you can make money in equities, but you probably it's a bit of a riskier proposition to store value because you just don't know what they're going to do. If Elon Musk, God forbid, was to have an accident or something like that, I don't know, plane crash or something like that, what would happen to Tesla stock? At a tank, right? And so you have all of these inherent existential risks. Hey, Braden, nice to see you. So, thinking about these characteristics and how they play against each other for store of value, which is really what we're trying to do. We're trying to escape a broken monetary system in a way that we can transport our economic energy through time and space to create the future we want on our terms and live our life in our way. And you want to do that at a rate that is going to be better than the debasement rate of the currency. So these are the kind of things you need to pay attention to. But anyway, let's switch gears. Let's talk about global liquidity.
Awesome.
Where do you want to start?
What is happening? Well, I think we start at what is happening because that's the best place to start.
That is the best place to start. You know what? So what is happening is global liquidity. Let me just find a couple of things actually. So global liquidity peaked last year at, let me just I'm just quickly checking some numbers. Global liquidity peaked last year at about $175.8 trillion, and that was in September. And then it declined. Then it started declining, right? And then we started getting a bit of a squeeze. So it'd been on this upward trend of global liquidity up till about September, and then it was a pretty sharp downturn. It went from 175.8 trillion down to 173, 172, 171 in December, 171.12. Now here's the thing, right? And we've seen this tightening in financial conditions and all this kind of stuff as well. But since December last year, where it was 171.12 trillion dollars of global liquidity, it has now increased on the 21st of Feb. The global liquidity, as measured by Michael Howe at Cross Border Capital. There are different ways to measure global liquidity, but I think he does a pretty good job because he factors in bond volatility, which is, I think, a critical thing that most people forget and miss. So global liquidity is currently at $173.61 trillion. So that's an increase of let me just quickly find my numbers in here. That's an increase of 4.32% in just 2 months. Now, let's put that in context. It is still not higher than the peak, right? So we're still at 173.61 trillion. The peak was in September last year at 175.8 trillion. So we're still not higher than the previous peak of global liquidity. But what is interesting is that it is a significant trend reversal and is continuing to trend upwards. Now, what is, and this is going to play into, we're just going to put all the topics into a blender now because they're all related together. So markets right now are crashing, right? So if anyone opens up anything to do with any kind of stock market at the moment, particularly in the US, you're going to see reds. Everything's going to be everything. Bitcoin is down in the low 80s, altcoins in crypto, everything, basically everything has lost all of its gains. Everything's gone back to where it was in about November last year. So everything had a rocket ship, like there was all this rocket ship growth from basically the US election, peaked up, and now everything's pretty much all the gains have been erased, which is crazy. That is happening. That is happening partly because we also had a decline in liquidity, and there's a lag between between liquidity movements and asset price movements. But also, it's related to fiscal policy as well in there as well. So what's happening right now is we're seeing liquidity is actually rising. But what I'm seeing in all the bloodbath that's happening out there in the markets, Nasdaq's down, S&P 500's down, Bitcoin's down, Tesla's down, Palantir's down, everything is down. What happens right before governments say, oh, something's broken, we need to fix it by pumping more money? Things have to break. Things have to get painful and bad. And so we can see that global liquidity is already starting to tick up. A 4.32% rise in 2 months is a 28% annualized growth rate in global liquidity. I expect, based on what I can see, that we're going to see global liquidity steeply starting to rise towards the end of the year. Now, there is typically somewhere between an 8 and 12-week lag between global liquidity rising and risk assets rising. Now, what you'll find, given the macro environment that we're in, is risk assets are always going to outperform non-risk assets, and that's because of the financialization of the economy and the increase in the proliferation of fiat currencies and the greater decoupling of fiat from reality. That actually pushes more liquidity into risk on assets. So risk on assets are going to outperform risk off assets until we have some kind of fundamental reset of the entire global economic system, which I don't see happening. Like that's a theoretical someday in the future. So there's a lag of roughly 8 to 12 weeks between global liquidity rising and assets rising. Now, one of the things that's also pushing down asset prices at the moment, particularly in liquid markets like the stock market and all that kind of stuff, is rising tariff tensions. So there's a lot of geopolitical horseplay at the moment, which is causing market uncertainty and concerns, which is squeezing the equity markets down. Now, the reason that this is not going to be tolerable for any government is because most of the equity markets and most of the liquid asset markets, so everything from bonds to equities to paper gold, all of that kind of stuff, most of those assets are owned by pension funds, insurance funds. And so what happens when those things drop? The collateral base for pension funds and insurance funds falls, which puts the entire economy at risk. Because if all of a sudden the pension funds start to crash and lose a bunch of money, is there going to be enough? Are they going to have enough assets to be able to pay out pensions? Are they going to be able to do these kind of things? So it really matters. And so governments are like, well, we can't let the markets crash. And so I think that this kind of pain precedes a shift in monetary policy and I think what we'll see in the next couple of weeks, couple of months, I think we'll see an official, because what we've seen is global liquidity increasing. We've seen monetary policy easing, but most countries are still in a state of quantitative tightening, QT. And so what we'll see is an official end to QT and an official start of QE. They'll probably call it something else because everyone knows that QE just means money printing, but we'll start to see the official start of QE. So what's super interesting to me is this bifurcation of these two ideas. Global liquidity is heading up. Risk assets are heading down. But nothing has fundamentally changed about any of the risk assets. So nothing's changed about Bitcoin. Adoption is still high. But there's more people buying Bitcoin than ever before. There's sovereign wealth funds buying Bitcoin. I think I can't remember, it was Abu Dhabi or somewhere in the UAE or something like that. They bought $534 million of Bitcoin 2 weeks ago. Michael Saylor bought $2 billion worth of Bitcoin last week. There are more large buyers of Bitcoin. So there's more demand, right? There's more adoption. The adoption rate is increasing. The demand is increasing. Okay. Look at the technology companies. Look at your Teslas and your Apples and your all this kind of stuff. Nothing's changed about their business. Nothing's changed about their business. And when you see everything fall at once, it's actually it's a lot easier to say, well, probably nothing's changed about the business. So global
they can't
liquidity
all have broken at once. Yeah,
exactly. It's not, well, pretty sure they didn't all
the
break
CEOs
at once, right?
quit at the same time.
Exactly. What it points to is a destabilization or uncertainty of the financial market And that then reduces collateral values, which means that the governments will be forced to step in. And so when I see global liquidity rising and I see asset prices falling, this is not financial advice, to be clear, but this is a buy the dip. This is a buy the dip opportunity. Yeah, I mean, this is like, okay, so if you could look at assets and go, fundamentally nothing's changed. Like, think about it like this way. Imagine if nothing changed in Australia. We still had ridiculously high immigration. We still had an incredible shortage of properties versus the amount of people who want them. Wages continued to rise. So let's just say nothing changed, like literally nothing changed. We had the same amount of demand. We had the same amount of all of that kind of stuff. But then overnight or in the space of a week, house prices fell by 30%. What would you do? For me, I'd be like, oh my God, it's Black Friday. Oh my God, this is like Boxing Day sales. Like how many can I buy? And so particularly if you can understand that the core driver behind all of this is liquidity, and liquidity is rising, right? So the engine room of growth is moving upwards and prices are moving down right now. Like that says that's market irrationality. And that to me represents an exceptional opportunity. It's like, wow, this is the time. This is the time you got to run into burning buildings because everybody else sees red and they go, oh my God, this is terrible. And I'm scared. I don't want to participate. And there's people who probably bought stuff in the last couple of months and it's now gone down. And they're like, oh my God, this sucks. It's like, no. This is the thing you're waiting for. In 12 months time, you'll be like, that was the greatest gift I ever got. Like if you go back to COVID, when everything crashed by whatever, 40% or whatever, the companies hadn't, that was actually slightly different because for a lot of the companies, things really did change, right? Because, supply chain, logistics, everything, a lot of stuff actually did change because of all of the, controls that were put in place at the time. But fundamentally, all you needed to do was buy at the right time and you would have made a ton of money. Now, this is a situation where we don't have things like global lockdowns. We don't have, the main risk is tariffs, right? And I think that most of that is just geopolitical posturing anyway. But anyway, what are your thoughts, Gabby, on global liquidity and or / markets crashing?
Well, to your point about the timing being like there's actually good opportunity here. Like it's the classic Warren Buffett quote of be greedy when everyone else is fearful, right?
Yeah.
And I think another element of like Buffett is his value investing as well, right? Because there's a difference between the value of something and the price. Like they're different functions, and the price is more susceptible to market manipulation, to consumer sentiment. Like how does everybody feel about this asset? And that is a layer on top of the value that influences the price. And so just part of us wanting to have these conversations is trying to get as many people as we can into positions where when things kind of turn, you are ready for it. And it's not to say that this is turning, but it's just like when you see things go a bit red and everyone else is like, oh shit, there's a crash coming. And you can see actually, so for example, like Bitcoin, we've had all-time highs in the last couple of months, but now it's back at like 80K or whatever it is. I'm not sure what it is today, but that if you are a Bitcoiner, you're like, that's a good price. Like,
yeah.
Whereas people that are not as informed are thinking like, oh, that looks like it's crashing. That's a bad thing. And it's this classic trying to make sure that you are aware of what's happening. So you're objective about the changing in the price and not just watching that and reacting to that based on what everyone else is saying, and trying to help you get prepared as well so that you can seize opportunities as they come up.
Yeah, 100%. And so like there's two components here. One is fundamental analysis and one is technical analysis. Fundamental analysis allows you to identify the what, and technical analysis allows you to identify the when. Now, you don't need to become some expert on charts and data and graphs, right? But what you do need to understand is the fundamentals of why you're investing in something. If you don't have a fundamental view of why you're investing in something, you shouldn't be investing in it at all. So, for example, let's just take Tesla. And again, I'm not trying to. This is not a suggestion to go and buy Tesla. It's just using it as an example. if you have a fundamental view that Tesla is going to significantly increase in value over time because of the nature of its robotics, its AI, all of this other kind of stuff, and that because of these characteristics, it's likely to be worth a lot more in the future than it is today, then you have a fundamental point of view that means that price volatility, day-to-day gyrations of the market won't bother you, because unless they decide to stop their Optimus bots, and unless they decide to stop full self-driving, and unless they decide to stop AI, then the fundamental thesis hasn't changed, in which case the only thing that's changing is the price. It doesn't really matter. The price should be an indication of when to buy. Now, you don't want to buy when things are at the top. And by the way, and so just I want to give you an example as well, because you mentioned Warren Buffett, value investor. Most people think value investing is finding companies that produce good cash flows. That's what most people think value investing is. Oh yeah, I'm going to find a company that if it doesn't produce dividends, it is not good value, right?
And there's analogy just quickly with that as well, obviously with investment properties. Like, people think it's only a good investment property if it produces positive cash flow. So it's a line there.
Correct. So one of the best value investors of all time, actually outperformed Warren Buffett, by the way, over a period of time. One of the best value investors of all time.
It was Goose McGraw. Surprise.
It's me.
You won.
No, it's Bill Miller. So it's a very interesting story. So he was a value investor. And Big Bill Miller.
Billy.
He was a value investor, and he started investing in Amazon whilst it was during the .com period, during the 2000 period, right? So he actually started buying it when it was $107, which was basically near the peak. Then it crashed, and he just kept buying it. And everyone's like, why are you buying this, dude? It is crashing. And he's like,
give up, man.
He was just looking at all the numbers in the business. He's like, shipments are up, operating leverage is up. He was looking at all of the metrics in the business, and he's like, well, the business keeps getting better and the price keeps getting lower. So he just kept buying and buying and buying and buying and buying. And he ended up being, he bought all the way down to $5.50, and he just kept buying. He ended up being the largest individual shareholder of Amazon. Now, everyone thought, Amazon's a tech company. Value investors don't invest in tech companies. Amazon doesn't even produce any profits. Oh, this is crazy. But the basis of being a value investor is understanding if you can find an arbitrage in what the market perceives the price to be and what you can perceive the price to be. That's where the value investing mindset comes in. And he was able to see, well, this is a great business that just keeps getting cheaper. So the value is there. He ended up becoming exceptionally wealthy. He ended up owning more of Amazon than Jeff Bezos, right? He ended up being the single biggest shareholder because he just kept buying. It was crazy. Now, the same thing kind of applies here. If you can see through the noise and see what is actually happening in the markets and go, okay, what is happening with liquidity? What is happening with geopolitics? Where is the money flowing? Why is the money flowing there? What does that mean for me? Now, by the way, global liquidity going up, we've covered this before, but Australia is a net importer of capital. So when global liquidity increases, more money flows into Australia. More money flows into Australia. What happens to Australian asset prices? Australian asset prices go up. Most of the asset value in Australia is stored in real estate. Does that mean real estate is going to perform better or worse when there's a higher global liquidity environment? Better. Right. And so we can start to then use this information to our advantage to go, oh, okay, cool. Like I can actually do something with this. And by the way, just going back to the kind of analogy we were using earlier around timing and stuff, looking even in real estate, looking for those opportunities that are underappreciated is actually where you make the most amount of money. That's how our clients have had the most amount of success over the last few years is not buying when everybody else is like, this is a hotspot, this is awesome. It's buying before then. It's buying when people are saying, why are you buying there? That's crap.
Yeah.
So
because relating that to your mate Bill, old mate Bill. Old mate Bill. I'm trying to think of the ice cream. What's the ice cream? Bubble O Bill. That's what came to mind. I don't know why. Human psychology is very interesting because I think we do tend to focus and believe more in the things that seem risky and making decisions based on things that will protect our pain versus create more gain. We would prefer to listen to the voices, whether they're our own or external, that says like, no, this is not the right thing to do. There's too much risk here. It's not the right thing to do. versus even if everything objectively is pointing to this might be a good decision.
Yeah.
And so I think it's really interesting because it's like, layer that into real estate, like you were saying, whatever market you invest in, there's going to be people that are like, why are you doing that?
Mm.
And there's going to be parts of you that wants to go, oh, that person thinks that, I probably shouldn't do that. Or maybe and it seeds these doubts. And so
Yeah.
there's an element of this, it's like building that confidence in yourself to be able to be comfortable with risk and be able to develop the skills so that you can know that you're making good choices in terms of your investments and not having to just default to, because your brain will default to what it thinks is safe and will keep you alive the longest effectively.
Yeah.
And part of that is financially. So really developing that skill set so you don't get caught in other people's opinions of get out or don't do that.
100%. 100%. Yeah. It's such an interesting point. Yeah. I think it's, I can't remember the study, but it's something like 2 to 2.5 times. We have a 2 to 2.5 times stronger bias towards loss aversion than gain, than whatever, getting good stuff. So yeah, so it really does play against us, and it actually does hold people back. And so if you're able to control your emotions, you're able to make better decisions. By the way, just another little anecdote on the kind of FA versus TA, fundamental analysis versus technical analysis, and technical analysis being the timing and understanding. Okay, is it the right time to get into something? Why does it, is it overbought? Is it oversold? Why would I do this? Where's it going to go? So I spoke to someone last night who said, hey, I'm thinking about buying a property near, the new airport that's being built out in Western Sydney.
Mm-hmm.
Yeah. So he was like, you know what? I've got this great idea. I'm going to go and buy an investment property out near the airport because, the airport's going to start getting built next year. And that means the prices are going to go up. And I was like, everyone already knows that. Everyone already knows that. Or like most of that's priced in.
See, the thing is like, they're not wrong. Like the way that they're thinking about it, it's not completely wrong. They're probably going to see some gain more than if they bought somewhere else.
So the fundamental analysis of more people there'll be more demand there, more people are going to want to go there. It's a sound idea. The idea is sound, but the timing's wrong. So the idea is bang on. Yeah, absolutely. That's a good idea if you did it 2 years ago or 3 years ago. And whilst you may still make gains in the future, are they necessarily going to be better gains that you can get elsewhere, or is that gain already priced in? Because you've got to remember, markets are pretty efficient. They'll price future events in pretty effectively. So
yeah.
Anyway,
there's a layer of like maturity and experience, I guess, as an investor there as well, which again is why I'm talking about trying to develop these skill set, because it's like you with your brain and everything that you know now is very different to, the first year that we were thinking about property investing. And so back then it would have been similar, like, okay, what data do I have access to? I know I need to research more. And that can seem like a good idea. Again, the fundamentals, it's right, but there's such a layer of timing in there. And it's also, you get more just experience and skilled at being able to pick the right timing and the best opportunity for your capital, because there are so many opportunities. We're surrounded by opportunities for investment, and it's realizing, like, if I have $100,000 or however much, what is the most lucrative asset that I can put this into out of all of the assets in the world? What could I do
on a risk adjusted basis?
On a risk adjusted basis, yeah.
Yeah. Because that's the thing. Yeah. You have to factor in risk, because if you don't look at risk adjusted returns, you could chase yourself off a cliff, because you see all these, like, people getting 10,000x returns on weird edge case meme coins and stuff like that. But you could also end up losing all of your money. And so what you really need to look for is, like, what's the Sharpe ratio? What's the kind of risk adjusted return on these kind of things? And understanding how to get, this is why, and we've talked about this before, this is why having hurdle rates is important, because if you have a hurdle rate, then what you're not trying to do is get the maximum number. You're just trying to beat a minimum number. And that's a very, very, very important distinction, because rather than saying, like, how can I make the most amount of money possible? It's actually saying, how can I make sure I beat my hurdle rate without exposing myself to as much risk? And if you beat your hurdle rate, you're all good. And that is so different from, like, what's the riskiest thing that I can do to get myself the most amount of money? So understanding that is critical. And so I just let's maybe move to kind of to wrap this up. If you've got questions or stuff, drop them in the chat there. But I think broadly, all of this kind of points in a very interesting direction. Because what we've got is we've got all the gold stuff we talked about at the start is effectively corrosion of the trust and validity of a very major part of the traditional finance system. It actually calls into question the credibility of many of the actors in the financial system and strengthens the idea of holding alternative assets like Bitcoin and real estate. It actually makes them way more appealing, which again pushes financialization into those assets, right? Which is super interesting because people will start to say, I don't trust this as much anymore. Where else can I put my capital? To your point, where is the best place I can put my money with the best risk-adjusted returns? So they'll start to go, okay, gold doesn't smell good. Bonds don't smell good. Like, where am I going to put my money? Where's the best opportunity? And so things like real estate, awesome. Bitcoin, awesome. If you're into taking a little more risk and you want to be exposed to things like stocks and stuff like that, like right now, there seems to be a great opportunity to buy the dip because fundamentally what we can see is global liquidity is rising. And as we start to see financial market breakdown, what that'll point towards is governments starting to print more money to stabilize the market because they can't afford the collateral values to fall too low, because that'll undermine again the balance sheet of the nation. Undermine the balance sheet of the nation, you undermine the financial integrity of the whole country and the whole financial system. So these things will again be propped up by the fiat system, and that in turn, in and of itself, is effectively more money printing, more money debasement, more money flowing into hard, scarce, desirable assets. So when you start to see breakdowns like this, you can start to draw a line to go from breakdown here means X over here means Y over here, which means more money gets printed, which means real estate goes up, Bitcoin goes up. So you can actually start to follow this chain of events and start to be able to front run it and get a better point of view, get a better seat in the house to actually make better decisions. That's why I think this is so interesting, because what we're seeing is this breakdown, this breakdown of some of these traditional aspects of the financial system, breakdown of trust of what we've been being told, strengthening of other alternative assets like real estate and Bitcoin, increases in liquidity, which we know is going to drive asset prices up, breakdowns of financial markets, which we know is going to lead to government money printing, and shifting of how people are kind of thinking about this on a global scale. Have you got anything else you want to add to this to kind of wrap it up and recap on this?
Just I wanted to nudge everyone. Like, I can see there's a bunch of people that are here live. So if you do have any questions, maybe if there's questions, just considering everything we've talked about all these different asset classes, things that are happening. Like, if you've been thinking about a strategy that you've been thinking about following and you want to get Goose's brain on it, my brain on it, now's a good chance to be able to do that. I also love if you do have questions after this episode. One of my favorite things in the week is when I get a notification that someone's left a comment, because that's another sign of, we're adding value. You want to be able to ask questions and you're like showing up and kind of engaging in this community. Like that's one of my favorite things. So if you don't have a question now, or you do have a question later, chuck a question in the comments of this YouTube video.
100%. Cool. Well, I think that's all we got for today. Gabby, slightly shorter one today, which is good, refreshing.
It is slightly short. It's funny because at the start of the episode, because we talked about gold for quite a bit, and then I was like, this is going to be a long one, but wrapped up quicker than I thought.
Yeah. No, it's good. All right, cool. Let's leave it there. Let's wrap it up. Leave us comments on the YouTube video. We will get back to them. Love you long time. See you next week.
And I'm not talking to you for the rest of the day. Okay.
We've got a couple of questions coming through. Does this mean lean more into other assets or property or both? Braden, I think everything that I have said points to a strengthening in real estate proposition. So real estate is a sponge for liquidity, and it has way less counterparty risk. You can't dilute. It's very hard to dilute. Obviously, you can increase the broader supply, but you can't print more of that property you own. Right? It's a physical kind of asset, scarce and desirable, and increases in liquidity. Real estate is a sponge for liquidity. It soaks it up, particularly now that we're moving into a a rate cutting cycle where we'll see rates decline over the next year or so. We'll start to see those sort of ease off. Real estate is super powerful. Now we've spoken before about how leverage in real estate can help you to get outsized returns that you can't get in any other asset, and better on a risk adjusted return basis. So I'll always put real estate at the top of the list of things. Let me be very specific. Residential real estate in Australia, I put that at the top of the list. The problem with residential real estate in Australia, though, is the cost. So it requires a fair bit of capital to get into it. So you need, $100 grand or so to be able to get into it to start with. So failing that, and borrowing capacity, right? So the entry hurdle costs are quite high. Assuming that you can navigate those hurdles to get in, it's going to give you a better risk adjusted return than basically anything else that I've seen. And in case you can't tell, I think about this stuff a lot, and I look at this stuff a lot, right? So I
stares out the window, just thinking.
Yeah, I haven't seen anything that offers a better risk adjusted return than 10-to-1 leveraged real estate in Australia, right? Just it's or 9-to-1 leveraged real estate in Australia. That being said, I think that all of this as well also points to a very strong next sort of 8 to 12 months for Bitcoin. And again, this is just my opinion. This is not financial advice. So if you run out and go buy Bitcoin and you lose money, that's on you, not me. I might not even be real. I could be AI. You don't even know. So,
that'd be funny. We are robots.
we're just bits. We're just bits on the internet. So if you're just going to listen to bits on the internet,
aren't we all though? Anyway.
I mean, yeah. I mean, everything is just DNA is just code
bring it
anyway.
Back.
So
bring it back.
Okay, we're back. So, I think what that points to for me is strength in the Bitcoin market. I would be very cautious about what people would call altcoins or like crypto, as Bitcoin and crypto. I would be a lot more cautious as it relates to crypto, because I think that people are going to seek a bit of safety, and I think that Bitcoin represents safety. I think people are going to start to avoid risk once they start to lose faith in things. Once they start to see that there's a lot more cracks in things that they believe to be true, what they'll seek is what are the best risk adjusted alternatives. So I think real estate and Bitcoin represent both of those really good alternative options. On a kind of like a third rung of the ladder, I'm the kind of companies and equities that I like to invest in are typically disruptive technology companies, and they represent. They're cheap as hell. I mean, they're the same price they were in like November. Like it's just like, but they've all gotten better. Like they're all doing more revenue, producing more stuff. It's like, but they're the same price they were in November. It's like they're on sale. Like, so to me, that represents a very interesting buying opportunity. But but they do carry risk. They do carry third party risk. There's all kinds of things that can happen that can influence the share price. There's a lot more risk of volatility. There's a lot more risk of failure. All of that kind of stuff over any time over a long enough time horizon. All companies go to zero. On a long enough time horizon, all property prices go up. So there's a very big difference between those two ideas. So that's sort of how I think about it. So without giving you direct financial advice, Braden, that's how I'm thinking about it in the current environment. If you can buy real estate, awesome. If you can buy residential real estate in Australia right now, big go, like rip into it. Yeah. If you have surplus capital, or if you're not yet able to do that, then looking at alternatives, alternative scarce desirable assets, which are, scarce desirable assets like Bitcoin, that's a great alternative. Again, not financial advice, do your own research. And then as a kind of second ladder to that, if you're prepared to take a little bit more risk and speculate a little bit more on future potential, then disruptive technologies would be an interesting place to look. And again, you don't want to go too far out on the risk curve. You need to have a sound thesis, right? So for example, I'll share a company, and this is not a stock recommendation. This is not in any way, shape, or form. Just using this as an example. So Rocket Lab is an interesting company that I found very interesting, and we invested in quite early because we looked at SpaceX, and we looked at which SpaceX is private, and we looked at the valuation changes in SpaceX, and we saw how much the valuation of SpaceX, it was like 180 billion at the time or something, and it's gone up more since then. And it was private, and it was every round that it raised, the valuation was shooting up. And Rocket Labs was the only publicly listed rocket company that was sending commercial rockets into space successfully and reliably, and the only real direct competitor to SpaceX, and the only publicly listed one, a New Zealand founded company. So and they were trading it at the time like 1/18 of the price of SpaceX. So I was like, I mean, that looks pretty sound to me. There's not even there's no other real competitor for Rocket Labs or SpaceX, and Rocket Labs is publicly listed. So that looked like a really interesting opportunity at the time. And so when you look at those kind of opportunities, you have to really make sure you're developing a very sound fundamental thesis to understand why, and you have to look at them all. You have to really pay attention to it. You have to really kind of dig into those kind of things. So I hope that's answered the question.
Yeah, on the growth stocks, it's interesting because like we would love to be able to share more like strategies and tactics to find these yourselves, because obviously we can't tell you what to invest in. The challenge is that it's really just research. It's do shitloads, 10,000 hours plus of research, and you will develop your own conclusion. It's one of those things where you just have to put in the hours, because technically no one, unless you're financially like licensed as a financial advisor and engaged to give you financial advice, can talk publicly about particular stocks to invest in. So it's like we can't do that for you, and it's really just a matter of putting in the hours to do the research to learn how to pick these. Like that's what Goose has done over the years as well.
Yeah. So Braden's asked, how do I find those smaller companies? It's literally by doing that. It's by being curious and digging around and following little like threads of thought and poking around. You know, like one other super interesting one to me is organoid chips, right? So there's actually a couple of categories of things that we're not invested in because I cannot yet find the appropriate entry point into these markets. One of them is solar. Solar is growing exponentially, but I can't find a good solar company that I think is like that represents some like hyperscale, market dominant type. Like I haven't been able to find one. So the trend and the industry is super interesting to me. Haven't found the right vehicle. Nuclear, super interesting. Same kettle of fish. Can't find an appropriate entry point. I can find dozens of small companies, but it doesn't mean. So you don't dig deep on the exchange. Just dig deep on the internet. Start reading around. Start like start googling things. Let's say it's nuclear. Top nuclear startups, blah, blah, blah. Like just start really digging around. And then if you start seeing some names pop up several times, then you start to go, okay, I've seen them popping up a few times. Let me dig a little bit deeper into those and then see if you can, and then don't jump in straight away. Start to then think, okay, well, if they're doing that, how would I know if they're good versus anything else? And I'll go back to my original point. So organoid chips, which is super interesting because they're effectively microchips that are being built with on a brain substrate instead of like an organic matter substrate. Like instead of silicon chips, they are literally an organic matter substrate, which is the same as our brain. So they're called organoid chips. And there's a couple of companies out there that are doing it, but they're so far out on the edges that it's like, well, I don't even know if I can invest in them. I don't think they're publicly listed. I can't find the private entry point. They're also like still way out on the risk curve somewhere. So these things that I think organoid chips will be a very major part of our future because they can process like, I don't know, whatever it is, like 1 million times faster, 1 million times the amount of information, 1 million times faster at 1 million times less energy consumption. It is fucking insane. So you've got to start to develop an interest in these things and then look just like, how I got onto Rocket Labs. All right, space is a pretty big topic. Right? How can I start to dig around that? How can I start to scratch around the edges? And I started to hear, I didn't find Rocket Labs before everyone else. I just happened to find it early-ish, not the earliest. Heaps of people way earlier. But I found it early-ish because I was digging around and I saw a few people mention Rocket Labs and I was like, oh, okay. And saying, they're doing commercial. I'm like, okay, that's interesting. I just did some more research. So it's really about having the curiosity to kind of like dig and kind of like pour through that kind of stuff and find those and then developing a thesis. By the way, I'll give just one more. So I'm a big believer in CRISPR, CRISPR, as a technology, gene editing technology. It's crazy. They can cure terminal illnesses just by editing your genes. They just go into your code, into your genetic code, and they just go, oh, hang on a second, you've got what now? Boop, 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 boop. Let's just edit that out of your DNA, and then you'll cure it. They don't treat the symptoms; they cure it. They take the illness out of the body. It's crazy. Matt Pitt's great suggestion. Use Grok3 and deep research for all of this. So CRISPR, I'm like, hell yeah. But we held a position in CRISPR for a while and it did nothing. And I was just like, I just kept seeing the concept is great, but the commercialization is not great. And so we've sort of exited that position for now, but I'll keep an eye on it because I think it's a fundamentally amazing technology. So it's really about developing these interests in these things and just trying to follow those threads to kind of wheedle along it.
Yeah, I think in terms of research as well. So like Matt, you said Grok3 and deep. Do you mean DeepSeek or do you mean deep research?
No, deep search. Grok3 deep search is a yeah.
Got it. It's squished on my screen. It looks like two different words.
Yeah.
We also use Perplexity as well. So that's a platform that I live in most hours of the day, just in terms of being able to ask questions. They've kind of tagged it as like potentially a Google killer because a lot of people are using that to find more unbiased results and delivered in an easier way than just going through Google.
You can also, even with Perplexity, so Perplexity also has deep research mode. So you can move it to deep research mode to go to do that kind of stuff. You can also do deep reasoning, and you can also do academic search where it searches for research papers. So Perplexity is a really good tool to try and find answers you wouldn't find elsewhere as well. But yeah, I mean, the only solution, and by the way, let me just kind of take this as on a little sidestep. The only solution to finding these kind of like unique equity opportunities is lots of research and a preparedness to be wrong. If you don't want to do that and you don't want to have to like read 100 papers and compare financials and like really get into the weeds of it, which I happen to enjoy. So for me, that's fine. But if you don't want to do that, then what you should do is you should choose the easy path, which is residential real estate in Australia, and you can make a ton of money, right? And Bitcoin, right? Because that's the most pristine store of economic energy that we've got on the face of the planet. So those two things are pretty sound and pretty easy. You don't like, yes, you need to do research into Bitcoin because you need to understand it, but one Bitcoin is the same as another Bitcoin. So once you understand it as an asset class, you don't need to differentiate between should I buy this Bitcoin? Should I buy this Bitcoin? It's just Bitcoin. It's just Bitcoin. So it actually gets really, really easy and really simple. So there's easy and hard ways to play this game. And real estate is, again, I'll restate it. The best risk-adjusted return you're going to get is residential real estate in Australia with leverage. The most pristine form of the most pristine store of economic energy on the face of the planet today is Bitcoin. And then to establish a fundamental thesis of disruptive technologies to work out what companies you should invest in so that when the prices go down, you don't have a freaking heart attack and you see them as opportunities. You have to develop the fundamental analysis and the fundamental thesis. You have to know why you have invested. Same with Bitcoin, by the way. You have to know why you've invested. So when the price goes down, you say, so what? Or yay. Not, oh my God, have I made the wrong choice? Because you know that you haven't made the wrong choice because you've done the fundamentals, unless the thesis changes.
Yep. In terms of the three assets that you kind of outlined, we did do a really amazing episode. Like, it's one of my favorite episodes. They're all my favorite. Don't tell the others. But a couple of weeks ago on investment strategies for 2025, that whole episode was just about this. So do go back and check that one out. You just go to the YouTube channel and it would be on there from like maybe 4 or 5 videos ago. But yeah, that's basically like how Goose would invest this year. And so even factoring in everything we've talked about today of what's happening in the financial world, it still comes back to largely those fundamental mental asset types. So I do recommend checking that one out. Goose, we managed to still get to an hour and a half.
I know. Now we're going to go.
All right. Thanks so much, team.
Thanks, guys.
See you next week.
See you next week. Bye.